Hi, this is Doug Motley from JLAM. And one of the things that we pay a lot of attention to are the dynamics that are happening across the marketplace and in elements that we really have no control over. And one of those is the lending environment. And lending drives a lot of valuations and a lot of transactions in the commercial real estate space. So one of the things is we've seen a massive change in this lending environment over the last couple years. And I thought that that would be something useful to talk a little bit about, share some of the background on. And when we look at lending and capital and real estate, we kind of think about it from a demand and a supply standpoint. And on the demand side, one of the things that you can look at is the volume of loan maturities that are happening in each of the upcoming years. And we saw some of this with the GFC 15 years ago as well in a debt wall. And while we don't really think of it as that, we do think of it as something that's very important to pay attention to. And so if you look at the commercial real estate loan maturities that are happening in each of the next 3 years, in 2024, we have over $900 billion of commercial real estate loans maturing. In 2025, north of 500 billion. In 2026, over 400 billion. So that's well over $1.5 trillion of commercial real estate loans maturing in the next couple years. It's a massive number. What's interesting is you may have seen in the news the term extend and pretend. And that is something, a term that's used for short-term extensions that lenders offer to some of their borrowers to kind of kick the can down the road. And if we looked at this same graph in 2023, we would have seen a number that was about 650 to 700 billion scheduled for 2024. So how did it go from 650 or 700 billion to over 900 billion? Well, that's 1 year extensions basically that borrowers who had loans that were maturing in 2023 got, and it kicked out the maturity date till 2024. And we think that's something that will continue to happen and kind of spread out this 2024 number a bit. But there's only so much flexibility that lenders have for providing those extensions. Ultimately, kind of they need to come up with a longer term, more durable solution. So that's something that we're watching closely. But from a demand side in the marketplace, you do have this massive $1.5 trillion of commercial real estate loans maturing, in the next couple of years. Now, when we think about the supply side, it's a very different story. So you have a massive amount of demand, but on the supply side, we see very different dynamics. So to set the stage, about a third of commercial real estate loans are held by regional and community banks. So these are not your money center banks. These are not your international conglomerates or CMBS, mortgage-backed securities, but these are your traditional banks that you see on the street corners. And all of our banking environment has been hit with 11 interest rate hikes since early 2022. And that has been one of the drivers that's caused lenders, and most lenders, or over half, to constrain or restrict, tighten their lending standards. So they have a higher bar now, and they're willing to lend less money on any given transaction. And part of the reason for that is banks have seen over $1 trillion in deposits leave their balance sheet since early 2022. So as rates started increasing and you had some bank failures, which we'll talk about in a second, the comfort that borrowers had or depositors had in the banking environment decreased, and people took their money to places that either they deemed were safer or places where they could earn more money on the dollars of deposits they had. So think of moving your money to a mutual fund, money market fund. So again, a massive decrease in their lending base. At the same time, lenders also were faced with a big change in regulation. So when we had the failure of Signature Bank, Silicon Valley Bank, First Republic Bank, and even Credit Suisse, the international, very big international bank collapsing, all of those things happened in a relatively short period of time. And that triggered US regulators to come in very aggressively into the traditional bank environment and tighten standards significantly or increase regulations. And as that happens, lenders need to put more capital on reserve to ensure that they are a safe haven for the U.S. banking system. And as that happens, it becomes harder and less profitable for lenders to make loans. So all of these are drivers to the supply of new loans coming in to take out the existing loans that are maturing. The supply is decreasing. So you have this imbalance where you have demand being very high for the next couple of years at a time when supply is significantly constrained. And that is a dislocation that's very important and is going to drive some really interesting opportunities for properly resourced commercial real estate investors. And all of these things I've just talked about don't even touch on construction loans and that whole realm, but there's going to be very similar trends in that space. So when we think about some interesting opportunities in the next couple of years, this is the backdrop which we're really thinking about that, and how can we be best capitalized to take advantage of this imbalance between borrowers or loans needing a source of new capital because they have a maturing loan at a time when capital is really constrained by the traditional bank lending system. So there's going to be some really interesting opportunities. We're already seeing some of those and expect that to accelerate over the next year or so. Thank you.